while we have a session on alternative investments, the black box of portfolios. And it'll be unpacked by a great panel, including Jason Horn, Jonathan Ramsay and Stephen Tang. Okay, Jason is Managing Director and Head of BlackRock Private Markets Australia and New Zealand, so obviously well placed to lead us today. I'm sure he follows the Wallabies, having hailed from the Gong, but I note that much of his career with BlackRock and Merrill Lynch and Royal Bank of Scotland was in fact in the UK. Jonathan is a Director of InvestSense. He helps clients design and manage their own investment products and sits on several investment committees in that role. He has run his own consulting firm, served as CIO for a boutique hedge fund, and runs small company strategies over his 27-year career. And then rounding out this last of our panel structured sessions is Stephen Tang, Head of Consulting at Zenith Partners. In that role, he works closely with advice practices at the coalface of the delivery of investment philosophy. He, of course, participates actively in investment committees in that role and presents regularly to advice practices and clients alike. Stephen has what I thought before was a rare qualification. He is a CFA charter holder.
Hi everyone. So I guess the first thing to answer is why is BlackRock up here as an index manager? Do we have private markets? Well, here to tell you we do. We've got about $330 billion in it. Obviously, there are larger competitors, but it's part of the $9 trillion that we manage. And obviously, private markets and wealth and institutional, it's a different game. So what we wanted to do here today is really just set the scene on where we're seeing value in private markets, and then with the panel, we'll talk a little bit about how we can incorporate that into wider portfolios. So just with a little bit of an overview, the key themes in focus within the private market segment, obviously you've got tightening bank lending. That's creating a lot of opportunities within private markets. You've seen obviously Silicon Valley Bank, you've seen a lot of issues around the US, you've seen a lot of impact across the direct lending space. We see that as being a huge value add for the private market space. In addition, elevated needs for liquidity. So I think we heard a little bit on some of the other panels this morning, but obviously secondaries are important in this business at the moment. You've got a lot of closed-end funds where the valuations, whether that private equity infrastructure is holding up pretty well, but secondaries are increasingly becoming a theme that we're seeing across the markets, and that's both in the wealth space, very attractive return profiles, and also in the institutional space as well. And then finally, obviously on the capital and the transition, and we heard a little bit about infrastructure. If we look at infrastructure, there's about $200 trillion that's needed to get us to net zero as a global economy by 2050. That's a huge investment profile. Yes, some segments are going to take more value than others, but we definitely think that it's an area that we can't ignore. The unlevered yields across, whether that's infrastructure, batteries, whether that's grid stabilisation, is pretty impressive. And so it's an area that we think, whether you're in the wealth segment, whether you're in other investment segments, it's probably too big to ignore. Private markets, I guess, from an essential perspective on the economic growth side, what we're starting to see is huge allocations. So I talked about obviously the private credit piece. Obviously access, yes, it's one concern, but if you look on the right-hand side graph there, you've got the private equity AUM, and you can see where it's gone from sort of 2010 to 2022. If we're looking at about $9 trillion globally, private equity, public markets and valuations, I guess public companies, there are less of them. More companies are staying private longer. There's a lot more allocation into those prior to them listing. And therefore, again, this is just creating a disparity again between the public and private markets. There is a lot more value locked up in, I guess, private equity or private companies than we've seen over the last 10 years or so. And we do feel that that's going to maintain in terms of where we're seeing investment profiles. Increasing size, I don't want to go through this in much detail, but you can just see where we think, and this is coming from some statistical reviews that we've done, you can see where we're going. And if you look at 2026, we've still got a 47% increase from where we are going into sort of where we think by 2026 will be in that private market space. One or two areas that we'll discuss on the panel that we will draw your attention to, though, is within each investment segment. So let's take hedge funds, for example. There are huge dispersion allocation problems in there. So if you look at 2022, yes, there was some huge outperformance in hedge fund space. You know who they are. But actually, if you look at the top 20% of hedge funds, they probably outperform by they probably generate about 3 or 4%. But if you look at the bottom 20%, they underperform, they probably generated a negative 7 or 8% IRR. So actually, choosing the right ones and the right allocations within each of those segments is going to be pretty critical going forward. So obviously that's hedge funds. I think you're seeing the same thing with private credit. Speaking to you today from an Australian perspective, and as was mentioned, I've sort of been back for about 12 months after a number of years in the UK and Hong Kong. Private credit over the last 5 years has just proliferated in Australia, and for good reason. If you look at private credit direct lending in the US, it's probably 80-odd% of the market. Here it's probably 15 to 20%, and the banks are still dominating. So I can see why, but actually a lot of the credit managers haven't really been through a market cycle as yet. So actually, if you're investing into that segment, the one thing you're asking is, yes, what's your track record? Number two, do you have workout capabilities? Because they will be required. You'll probably get your money back. That's probable, but it's going to take 3 or 4 years instead of the 18 months duration that you've actually got. So it is important to be looking at the types of investments, but also who's running those investments. And finally, we talked a little bit about infrastructure and real estate. Now, real estate's obviously a negative term at the moment, given the issues around office, but actually there's a lot of huge opportunities in last mile logistics, childcare, healthcare, and some of these other areas. And so there are pockets of really, really good, strong real estate opportunities. And we feel, from our perspective at BlackRock Real Estate and our private equity side, we think there's going to be huge opportunities over the next 4 to 5 years. And that's global, not only Australia. Not necessarily in office at the moment, but in other areas. And private equity, obviously, that one is pretty well known. Valuations are one thing. But obviously, the public market valuations at the moment, especially across the US, are being held up by sort of 10 or 12 stocks. There's still a lot of value across the private equity markets as well, obviously, valuations permitting. And then the last couple of slides, these are just important. I think I'll really focus on the last couple, but in the right-hand side there, you've got the private market increasingly attractive. We talked a little bit about each of those structures there, but if you look at, this is taken from one of our BlackRock surveys across the global wealth and institutional programs. If you look at where there's increasing, obviously, commitment but interest, pretty much all the areas within private markets are increasing. If you look at infrastructure, for example, yes, we heard it before. Obviously, there's some CPI linkage programs there that makes that very attractive. As I said, real estate on the other side, office, not so much, but in other areas, it's definitely an area to watch. So the positive thing is that private markets in general are getting increasing. There's a lot more interest in those private market programs, and that supplements any public market programs that you might have. And then finally, just down the bottom there, it's just an interesting note to compare over the last sort of 10 years or so, where we think or where public versus alternative assets or private markets have gone. Obviously, it's grown exponentially since those early years, right the way through to sort of where we think we'll be in 2027, which is at sort of 34% and growing. That share will increasingly, push out as we go out to sort of 2030 and beyond. And just before we hand over to the panel side and we start talking with the gents, we just wanted to look at some of the challenges, because we do know that there's challenges investing in the private market segment. We absolutely acknowledge that, yes, from a wealth perspective, it's sometimes difficult to get in. But obviously, we wanted to just draw your attention to just a few of the areas that obviously are most important and people find as being the most issue allocating to private markets. So the illiquidity and lockups. Obviously, that's something that most of these private market programs are closed-end, although you are starting to see a lot more open-ended vehicles. You're seeing a lot more open-ended infrastructure vehicles, a lot more credit and private credit vehicles, and I think that trend is absolutely going to continue. We are doing a lot more in that open-ended space than we have ever before, acknowledging that the closed-end piece is going to be more difficult. And if we really want to tap into, especially in Australia, we really want to look at the wealth segment, which is huge and growing. We're really going to have to really look at that illiquidity premium and how we actually justify. You've obviously got also a proliferation of, I guess, what you would call platforms across the industry that's making it more and more easy, I guess, for investors that come in, whether that's capital call, whether that's allocation, or whether that's access to the best products on each platform. I'll touch on just a couple of the others. Obviously, the legal structures. BlackRock's a US firm at heart, so obviously trying to get Australian unit trusts and things has been a little bit more difficult over the last year or two than maybe even what I would have thought. But I think the appetite is there, and you're starting to see a lot more managers globally come down, bringing their best products to Australia, and you should take advantage of that. But always push back on obviously what you think you need in terms of your legal structures, because I think all the managers are really starting to look at this. And then obviously we'll talk a little bit about sort of that 29% allocation there, the risk profile of private assets. There are a lot of investors that don't fully understand how it impacts their portfolio. So obviously a lot of work needs to be done on that and how it interacts with your public and private positions. And then obviously down the bottom, you've got valuation issues and transparency. They're very well known, so I won't touch on that, but it's obviously something to keep in mind. Traditional approaches, I guess this is really just to outline probably the four main areas, discrepancies between the public and private markets. Again, it's pretty obvious there, but the illiquidity piece, difference between getting your money back and not, that's something we're trying to change. Obviously, the secondary market is making that opportunity there, but valuations are obviously key, and you've got to have a seller on the other side. The opaque valuations, again, as we have more and more of these very sophisticated platforms coming on board, those opaque valuations are becoming easier to get around, and you are going to be able to get valuation points across that private markets side. And then access to data and implementation. I think obviously the implementation side as well. I will say that as there is more and more of these of the platform pieces, that is getting easier. KYC, doing all your reviews and things like that. That's absolutely now starting to become more mainstream. I'll probably miss that slide and just move to the very end. Relative values across the private market standpoint. So where we see opportunities, we've touched on a few of them, but obviously the private equity space is very interesting. Lower entry valuations, secondaries, very opportunistic, but obviously you've got to have a seller on the other side. We feel that will continue to proliferate as obviously there needs to be movements in liquidity going forward over the next sort of 18 months to 2 years in this higher interest rate environment. Private credit, I think you'll agree globally, definitely in Australia, definitely in the US, direct lending, absolutely key. It's going to continue to increase in terms of not only its return base and profile, but on the other hand, you need to make sure that your managers are in line with, they understand how to actually work out positions that maybe don't go so well. But we still do see there's a lot of value in that. Infrastructure, and especially climate infrastructure, we do feel that there's a lot of opportunity there. The unlevered return profiles are extremely good, and we think that will continue. We don't think that this is going to change anytime soon. The push to net zero by 2050 is here. It's real and it's going to happen. And there's got to be a lot of allocation of private market liquidity. Governments and public markets can't do it all. And finally, we touched on the real estate side. Opportunistically, the different sectors, very, very opportunistic, but very, very good, and should also and always be inside your portfolios. So that's just a bit of a roundhouse overview of where we are seeing value and what we're seeing across the private market landscape. And now I'll probably hand over to the guys and we'll talk a bit more on the panel. So James, one or two, I don't need this, or I do need it. You do need it. I do know. Okay, so I guess I've given a bit of an overview about where we're seeing the private markets and the landscape. I mean, maybe we start with you, Jonathan. What do you see as the largest gap within the private markets landscape when it comes to the Australian market?
Well, we don't really see alternatives, and look, Stephen and I were sort of probably ready to talk about listed markets as well. So I guess I'll answer that, including listed markets as well as private markets. And I think sort of generally, we start off with a zero allocation because the devil's kind of in the detail really with all alts. And each individual investment has to be there for something that's kind of reasonably specific to itself. So we don't really see it as having boxes to fill, or we have a zero strategic asset allocation, and we build up from there. And at the moment, it's pretty low actually, the sort of dynamic asset allocation, if you like. So in terms of what's missing, it's kind of like a miscellaneous question. I wait until something comes in the door and I say, oh, well, I needed that. It was missing before, but I didn't know it. I don't think there's anything, a screaming need for something that everyone else is enjoying elsewhere and we just don't have access to. At least not in a retail environment, I don't think. Sorry if that's a boring question for an answer for an
Yeah, no, it's a good one. And I guess the following question, has it changed? I mean, that might be now with obviously interest rates where they were, say 5 years ago. Were you still looking in that sort of era?
Yes, I think the probably that's why there's maybe a little bit of less of a need, but it feels like this cycle hasn't really completed itself. So when risk premiums were really, really low, you kind of the hurdle gets lower, so you go looking for other things, and you hope that they have different attributes. Risk premiums, real risk premiums, arguably, depending on where inflation ends up, are kind of okay. So I think the need has dissipated a little bit. And then I think and this is kind of, I think we're going to come back to this again and again. I don't know about Stephen, but this sort of vexed question of whether there's a recession or not, and how some of these things react in recessions, especially if we're talking private markets. That probably puts a little bit of a dampener on there. Maybe I want to see a stress test first.
Yeah, look, I mean, I think that's an interesting way to look at it, because I think we see that in the credit space. Obviously, high yield, you're getting a lot of value within that space versus, say, the private market piece. Obviously, there are differences with how you would look at the contractual revenues, and obviously, if you've got debt covenants and things like that, which we feel does add a lot of benefit there, which you maybe don't have in the high yield programs. But definitely understand where that's.
So you'd say on a yield basis, you're getting more value in the listed high yield space.
I think you're getting value. I think as you move into the private market, so yes, you might say over the high yield space, you might get 100 basis points more or so, which is probably not enough value for in your perspective to move into that private markets. But what I am saying is that you do have the benefit of the debt covenants, and you can actually squeeze, those whoever you've lent to and those companies a little bit more in terms of you get, I guess, a better view on where those payments are going, and do they have the ability to repay, as opposed to the pure high yield that you're finding out very late if there's a default. Yeah. Sorry, Steve.
That's okay. No, from our perspective, there's been a lot of proliferation in the private asset market in the recent years. To your point, like 5 years ago, I think you would have struggled to find a lot of product to invest into. If I had to pick one, I'd say unlisted infrastructure. Interesting, you said there's more product in that area. I can't think of a product myself in the unlisted infrastructure space. But everywhere else, I think you've seen a proliferation of private equity more recently. To your point, they're quite well diversified programs as well. So it's interesting you mentioned secondaries. You can access secondaries, but it's generally not in a more, I say liquid. It's not the really liquid form. The more liquid ones tend to be more diversified because they obviously need sort of that sort of profile to actually have that more liquid profile. So, we do see an application in more liquid portfolios for some of these products, but they're certainly not applicable to most of them, because once you put a very liquid product in there, you're going to lock up a managed account, and that's the last thing you want to do for any of your clients is lock up your managed account. So we do some limited application for some of these vehicles in a managed account, and it depends on the platform, so don't go telling everyone that they can put it in. But the platforms are looking at this. I mean, it's been a space that everyone's been asking. So from our perspective, we certainly are seeing client demand for these type of assets. We actively look at them, and we do sort of think about how can we put them in portfolios where it makes sense and in a way that wouldn't lock up their vehicles. So we certainly see, there's lots of product. Probably unlisted is probably the part that we don't see a lot of product. Just on the hedge fund space, just quickly, interesting you touched on the dispersion of returns, and that's the complication in alternatives in general. It's the dispersion of returns. Like, everyone's used to thinking about asset classes in a homogenous sense, and when you get to alternatives, even if it's in liquid hedge funds or unlisted products, it's not. It's like, one program can be vastly different to the other program, and you're thinking, why didn't I get that return for this fund, and this fund gave me this return? The reality is it's really around doing your DD on this space. Like, if you don't do your DD and it takes a lot of work, then you're wasting your time too.
Yeah, I'd agree with that. I think it's DD, it's also access. So obviously the fund to fund program have probably been a little bit more interesting in the wealth space over the last sort of 5 years or so, simply because you get a bigger or a broader sort of remit. It's also easier to access some of those larger managers. But absolutely take your point. And on the dispersion piece, we are seeing a lot of that. And I do think that if you look at the volatility in public markets, you're going to continue to see that. You're probably not going to see too many hedge funds really outperforming over the next 12 to 18 months. I think if they're positive, that's probably what they're meant to do, and protecting on any downside. So I do agree with that. I'd probably like to touch on one point. I mean, the liquidity element, that comes up a lot, and you mentioned, Stephen. I mean, what would be interesting for you in terms of liquidity? So does it have to be daily? Can it be quarterly? How do you look at that?
From our perspective, it depends on the client and the vehicle that you're using. So for a managed account, the maximum you can use is as a monthly liquid vehicle. Like, you can't actually put anything more. The platforms won't let you. We've been having discussions with platforms about how we do it, and they flat out will tell us you can't put anything more than monthly liquid. Which monthly liquid, just to be clear here, it doesn't mean that you're going to get your money back in a month. It actually could mean that you get your money back in a bit longer than that, but it's a monthly liquid vehicle that you can put into a managed account vehicle. And again, I would be really careful in doing that in a managed account if you're not cognizant of the lockup you could cause to your broader portfolio.
And I'd sort of go exactly echo that and go a step further, and you've got to make absolutely sure that the underlying is just as liquid. I think some of these sort of liquidity mechanisms work in good times generally, and liquidity is correlated to equity risk premiums. It's going to get illiquid at exactly the wrong moment. So for that reason, it's something that sits outside the SMA. So we run a kind of a panel, if you like, of things that you can do outside of the SMA in the illiquid space, but in the SMAs, it's liquid.
Yeah, look, I think liquidity is a very interesting term in private markets. I don't love to see everything that's liquid, just because, to your point, everything's liquid until it's not. And often, even if it's monthly, you could be in a line and you could be waiting for that redemption profile for 6 to 12 months. And I also think that, some of the programs, especially private credit, that one's going to be the interesting one. I always use the adage, it's liquid, but if you're lending at sort of a 14% IRR, someone's paying that back. And at some point, maybe they're not going to be able to pay that back. And so then you're going to have to go into the asset recovery position, and that never goes as smoothly as what you think. So your 18-month liquidity position becomes 3 years or 4 years. And I think we're in danger of seeing that a lot more over the next 2 years or so than maybe what we've seen over the last 5.
No, totally agree with you there, Jason. So I think one of the questions is going to be, where do we see people ask us about? Private credit's probably the most. I went to another conference, and that was the number one asset everyone wanted to talk about. I think we haven't seen a recession in Australia for 30 years. We haven't seen these managers work through a cycle. So I think you'd want to make sure, and for my sins, I used to cover all the fixed income managers, and they always used to talk about, fixed income is all well and good till it's not, and then it's too late. So the problem is, it looks really good right now, and the yields look attractive, but no one knows what's going to happen in a downturn. Like they do need, to your point, workout teams. Workouts are going to happen whether or not it's recession or not. You're always going to have issues in your portfolio. So that's been the case for anyone. And I'm talking to a bank loan team recently. Bank loans are more liquid part. They were saying exactly that fact, is that they've got workout teams. A lot of the people they face off on the other side don't seem to have that capability.
And I think there's a bit of customer communication that we haven't really rammed home yet. From us to advisors, well, from managers to us, from us to advisors to the clients. Because I've been in a workshop when we've sort of worked through some of these things, and we've said, now, the way these things are designed, the money could get sort of locked up for, 6 months, a year, maybe longer than that. And there was at least a few jaws that dropped. And this is, advisors investing in private credit because they didn't think that was conceivable. But I'd go a step further, because I've actually asked this of some managers and said, right, can you give me a stress test? Exactly to Stephen's point, not one in Australia, but one in Australia where you have the kind of recession that everyone else had 10 years ago. And can you walk me through, the lockup, the drawdown, the workout provisions, the team you've got in place, how you're going to, this has happened on 2 occasions, and that's never going to happen, was the answer. That was the stress test. And I kind of feel there's kind of more to be done there.
Yeah. Yeah, actually, it reminds me. So I was in London in 2007-8, and when I would come back and see a lot of my buddies who are in the markets, the GFC was just an acronym, and Australia did very well through that period, but it was a bloodbath elsewhere. I'm not saying that that's going to happen this time, but it's something to be considered. So I agree with that. I mean, just on your side, Jonathan. So let's say we look over the next, say, 5 years. I mean, what would you need to get more comfortable, or what do you need to see to start then allocating more to a private market allocation within your products or within your portfolios to then cross-reference with your public market holding?
So, obviously so if we're talking private credit, what's the main reason for being there? Well, it's sort of, some kind of return premium. And then it's we're sort of talking around the same thing, but what can go wrong? I need to have a better sense of what can go wrong and not just be told that it's not going to go wrong. And then that lets you take scenarios to advisors that they can take to their clients and say, is that okay? And if they say yes with that, then that's fine. I don't feel that information is really available for a lot of these products. So that's, partly the due diligence on our account, partly the communications with the fund managers, and partly the communication to the underlying client.
Got it. Similar?
Yeah, I think it's similar to Jonathan. I'm not going to add a lot there, but I mean, you just need to do your DD. You want to know that your team that you're managing, and this is pretty broad, but has experiencing in doing what they say they're doing. In Australia, as I said, you haven't seen people work through this in the private markets, and so I'd be reluctant to go whole hog until you see somebody work through an issue and see what actually happens. It's all well and good, Jonathan. He's right. Most of them say it's never going to happen in Australia, but I'd like them to show me what they did in a workout situation. Don't just tell me you're going to do this, this, and this. We can handle it. No, show me that you can actually handle it and how you've done it, and what sort of recovery you've got after that.
Actually, sorry, I'd just like to return to your original question, because it did I remember before the GFC, distressed debt funds were sort of capitalising in advance. And there were a few that sort of landed in Australia. And that was actually sort of quite a prescient thing. And by and large, they worked out pretty well. This time around, sort of not so much. Is it because the private credit manager is kind of morphed into that, and that they will become distressed debt managers? Or, what's the trend there?
Yeah, it's a good question. To answer that very, very bluntly, I think that's very dangerous if a private credit manager is starting to move into scope creep on distressed assets or distressed debt. I think you are starting to see some of the larger distressed managers raise, and they will be raising 10-year vehicles, because they need that long to obviously work out a lot of these scenarios. So it's probably not a wealth play in terms of, if you need that liquidity, then the distressed managers are not where you want to be. Look, I do think that there's going to be a lot of money raised in that segment. I think you're seeing quite a few of them gear up, but I'd be very worried if, say, private credit managers were moving into that opportunistic space, and the opportunistic were moving into distressed debt, because it is a very, very different profile. And if anyone tells you differently, they're lying. And I do think that there will be opportunities. I think there will be opportunities here. I think there will be a lot of opportunities across Europe and the US. But obviously the hurdle rate is higher, as we've talked about, because of where the interest rates are. And so how much higher? I mean, distressed assets, if you said distressed, say 3 or 4 years ago, and I said, well, I can get you 18, 19%, you're probably all right with that. Right now, it's probably got to be a 25 handle before you're even interested, given what you can get in the investment grade programs and moving into that opportunistic. Everything's ratcheted up. The other thing to note too is how much leverage is in those programs. Leverage can be pretty dangerous at these levels.
And actually, that's another, in terms of what would it take to get comfortable. I think in Australia, you've got to be comfortable about the real estate market, because so much of it is invested in that. I think overseas, and especially in the US, you've got to look at not just the leverage, but where's the adjacent leverage. And, you'd want to see a more settled environment, I think.
Yeah, I'd agree. And I think the difference between, say, us here in Australia and the US, our banks are very, very strong. Not so much in the US. Yes, your top banks are extremely strong, but you've got a long tail there that are probably just holding on in terms of their capital and liquidity ratios. And so again, you're going to see them pulling out of some of these lending facility programs, and that's going to put a lot of pressure, but also it's going to have a lot of value coming in from these private market deals. And I guess just the final, because I think we're running out of time, but we mentioned due diligence a little bit. So what are you mainly looking for in a manager if you're doing that key DD?
It's a very broad question, Jason, to be honest. As I said, you want to look at their experience in managing the assets they are. I mean, that's the key. It really depends on where you're looking. Experience is probably the most across, private equity, private credit. That's probably the one that you want to be looking at mostly. I mean, it depends on the assets you're looking at, though. So I would say you need to look under the hood and make sure you ask all the right questions, but experience is going to be the one that you're going to be looking for.
I just add, and this is where, different funds have different approaches to this, but it can be a problem, is, there's the hygiene stuff, but then there's what are you actually invested in? Show me the deals, show me what you're getting paid, and so that I can form my own view on what the opportunity is rather than, this is what it says on the sticker. And then, again, what could go wrong with that?
Yeah. Fine. Good. Okay. With that, I think we might leave it there, right on time.
Okay.
Any questions from the audience or not?
Oh, yeah, we've got questions.
I was going to say, Toby, you said we had the graveyard shit. You didn't say we couldn't eat, but we could swim.
No. I have look, Jonathan. I dream of inviting you to speak without also arranging for lunch. I actually have a question, which is the title of the session is "Do alternatives have a key role in portfolios?" And we've spoken, in depth and really interestingly about private markets. But for Stephen or Jonathan, alternatives used to mean, derivative-based strategies or other types of assets. Jonathan, you said at the start, look, we've got a neutral weight of 0 to the sort of private markets, but what about to the other more sort of traditional alternatives?
Yeah, it's almost like an oxymoron, isn't it? It's sort of traditional alternatives. By the time they become traditional, they're their own little asset class. Look, you go around the sort of global macro. Well, can you find a guy that does global macro better than anyone else, has better views? Trends, we know the sort of warts with that. I think it's a really interesting concept to think about when trends might work and when not, when there's a sort of regime change. Those sort of things could be interesting. Probably the boring answer is there's probably, and I keep on saying this, but stock picking opportunities. It's always a stock picker's market and never is, but there's probably things in the traditional, adjacent to the traditional markets, Japanese microcap, I don't know, things like that are maybe a little bit interesting.
That almost sits on the alternative bucket, I would say. But okay, yeah, from our perspective, yes, alternatives do have a place in the portfolios. To the panel's point, you really need to look, across the whole range of alternatives. Talked about trend. Trend works. You saw in specific environments, so it has a place in the portfolios if you're aware of how it can behave. We had 18 months of quant winter that did nothing or worse, and so you got to understand the profile that you're going to deliver from each of these assets. So they have a place, but you need to understand sort of how they're going to behave and be comfortable with that.
Quick question for Jason. I think I heard earlier in the presentation that when you were comparing public market to private market yield-based investments, you were looking at about a 1% premium, and you were speculating whether that was worth it for the loss of liquidity. On the growth side, what's that premium look like in your experience?
Yeah, on the growth, which part? So growth equity or?
Yeah, growth equity or even, well, yeah, let's just say growth equity.
Well, actually, let's put it into maybe venture debt versus normal debt. So we've actually moved into that market via acquisition, and if you look at where those venture debt pieces are trading, it's probably 23-24% before you get interesting. Whereas I would say, to put it into perspective, maybe 18 months ago, that was probably around 18%. And if you look across the US, Silicon Valley Bank was probably doing that at 15s. So, there's probably 3 to 4% in that segment. Growth equity is probably a little bit similar. You might want a little bit more of an outperformance there. If you're looking at, say, early stage venture versus true private equity that's got some sort of capital profile yield. But I would say that sort of mid 20s side on the venture side. Yeah. Investment grade versus, I was talking more the investment grade versus pure private market, very similar rates. So, that premium is now 100 basis points. It was probably 400 or 500 previously to that.
If we're going to get into expected returns for private equity, have we got another 10, 15 minutes or something we can...
As long as the valuations stack up, mate, yeah.
Okay, thank you, team.
Thanks.
Thank you.